I'd like to call this meeting of the subcommittee to order at this time. Today, we're delighted to welcome the Chairman of the Federal Reserve to present the Fed's report to Congress on monetary policy. I'd like to begin by congratulating him on his nomination for new terms as governor and as chairman. He has certainly earned the respect and confidence of the public for his stewardship of monetary policy. He certainly deserves another 4 years at the head of the Federal Reserve System. Mr. Chairman, congratulations.
Thank you very much, Mr. Chairman.
And some condolences, too. It's a tough job. There is, in addition, a very specific reason he deserves another term at the helm. The primary objective of his conduct of monetary policy, as he has reaffirmed again and again before this committee, has been and must be the gradual but inexorable elimination of inflation. In his first term, the Federal Open Market Committee launched monetary policy on a path that should, over time, reduce measured inflation to insignificant levels. Despite some ups and downs, the longer-term growth rates of M2 have been dramatically reduced over the past 4 years. As Chairman Greenspan emphasized in previous testimony, that decline in monetary growth has been no accident. It has been a necessary condition for reducing and eventually eliminating inflation. Though a necessary condition, I must note that it has not been yet a sufficient condition. Measured inflation has yet to register any significant break from its 4 to 5% plateau. I want to question the Chairman about the prospects for progress in reducing inflation in the near term. At present, I'd only like to call attention to several factors which have been impeding this effort. In the first instance, we must remember that monetary policy operates with lags, possibly very long lags. The major impact of reduced money growth over the past few years may still lie ahead of us. Moreover, the fact that measured inflation has not fallen over the past 4 years, it has, in fact, risen slightly, does not prove that the Fed's strategy has lacked any bite whatsoever. One must recall that monetary growth had been very rapid in the mid-1980s. The decompression that began about 1987 served, in part, to offset the rapid expansion of previous years. Though I cannot prove the point, I suspect that monetary policy since about the 1987-88 period has been has had a very significant impact on inflation. But that impact is not observable since it just stymied an inflationary explosion that would have otherwise occurred. The first 4 years of Chairman Greenspan's tenure served to arrest an accumulating inflationary momentum. Actually reducing measured inflation to trivial levels remains the objective of the next 4 years. I'd like to conclude by calling attention to the major political impediment that threatens to undermine that objective at every turn. To put it bluntly, this administration consistently refuses to support a monetary policy aimed at eliminating inflation. Despite what it says, its actions speak loudly to the financial markets, and those actions have been clear. First, the President dawdled until the last possible moment in reappointing Mr. Greenspan. That could only signal to the markets an ongoing campaign to bulldoze the Fed into reinflating the economy in time for the next election. Secondly, the Secretary of the Treasury seems to spend most of his time trying to browbeat all the major countries to reinflate along with us, if not ahead of us. It is very maladroit and potentially ruinous financial diplomacy. How do financial markets react to these episodes? They read in them a persistent pattern of political pressure on the Fed to cave into inflation. The credibility of a long-term commitment to eliminating inflation is undermined. The markets simply don't believe yet that inflation can or will be eradicated. Thus, inflationary expectations change very little, even in the midst of a recession. As a consequence, Long-term interest rates remain high, even when short rates fall considerably. The economy remains weaker, inflation more stubbornly resistant than they should be, and primarily because the administration simply refuses to accept the basic point about the purpose of monetary policy. Anti-inflation is the best policy for economic growth and prosperity. And their statements and actions, no matter what they say, even though they say they're for lower interest rates, in fact, keep them higher than they would otherwise be. By spurning zero inflation, the administration turns its back on the benefits that would surely follow. Long-term government interest rates would fall to the 3 or 4% range. Mortgage rates much lower than they are now. Consumer and business rates about half of what we pay today. The budget deficit would drop as the Treasury issued debt more cheaply. Savings and investment would be stimulated. Savers would no longer fear the corroding effect of inflation. Inflation would no longer undermine the long-term planning needed for productive investment. Productivity would rise, driven by new savings and new investment. Unemployment would fall, on average, to the lowest levels possible, since the economy would become more efficient, more productive, and less prone to recession. Since most recessions are byproducts of the periodic need to regain control over inflation, they would be minimized by a monetary policy resolutely targeted on zero inflation. Our major competitors have learned this lesson. Japan's prosperity and competitiveness are in large part a consequence of its success in stabilizing pricing. The same for Germany, and the same will hold true for a new European currency if it is managed by the commitment to price stability that will likely be mandated for a new European Central Bank. If for no other reason, we must achieve zero inflation to remain competitive in the world economy. Without it, we will face periodic recessions, stagnating productivity, the constant erosion of competitiveness, in short, economic decline. There is a right policy for monetary policy. It's zero inflation. Only by achieving and maintaining zero inflation can we achieve all of the other economic goals which will keep America number one. Mr. Ross.
Thank you, Mr. Chairman. Mr. Greenspan, I join the chairman and welcome you to our committee here this morning, because what you have to say means a great deal, not only to us here in Congress, but it has tremendous impact on our entire economy, and I think because we have a global economy and the world economy, so we hang on what you have to say. Now, I have to respond somewhat to the chairman's comments here, because I'm from the other side of the aisle. And the presidential candidates may not be out campaigning, but I notice from my good friend, the chairman here, and he's a very influential member of Congress, that the Democrats are not at a lack for a philosophy for this coming presidential campaign. Let me say that the next 4 years with you at the helm of the Federal Reserve are very welcome, I think, to all of us, because we have trust and confidence in you, and because we do hold you in a high regard. I wonder, however, with no disrespect for you and all deference to you, whether the President wasn't sending a message to you and your colleagues at the Fed by waiting until only recently to announce your reappointment, even though you were clearly the best choice for the job. Maybe the delay, simply put, in the light of the current state of our economy, is that the Fed shouldn't become too preoccupied with further lowering inflation, particularly if we would be at the expense, if it would be at the expense of the entire economic recovery. And I think we have to be somewhat dubious about all this talk about we got to keep inflation down even if it ruins our economy, because Mr. Brown, head of the Democrat Party, said good news for the economy is not good news for us, i.e. the Democrat Party. And we should try to get, I think, ring politics out of our financial picture more, and I think it would be to the betterment of our entire economy in our country. I would assert that worrying about inflation at this point in our country's economic recovery is like a cook fussing over the dessert while letting the main course burn. The Wall Street Journal recently pointed out that the lower inflation is not an issue with the American people right now, as they are perfectly happy seeing inflation chug along at its current 3–4% pace. However, I would assert that seeing this country rebound from its economic situation is a vital concern to every American. When I go back home and go around the country and talk to people, people never talk to me and say, hey, we got to do something about this inflation, but people do say, we've got to do something about interest rates, we've got to do something about more jobs, we've got to do something about our economy. And focusing on lower inflation would keep interest rates high, it would mean higher unemployment, and it would kill our country's economic recovery, costs which are clearly too high for the benefits we would be gaining. Thus, I'm anxiously awaiting, Mr. Chairman, your disclosure and discussion on the Fed's proposed money market targets, and I sincerely hope that the news is that the Fed is going to put its worries about inflation on the back burner for now and let the nation get on with the recovery. I also look forward to hearing Chairman Greenspan's thoughts on other important issues that may affect our monetary policy, such as the effects of the House's proposed banking reform bill, as well as its effects, and any of our other issues, for example, trust and confidence because of the savings and loan banks, problems in banking in all of our financial institutions. How can we rebuild the public's trust and confidence in our lending institutions? So I look forward, Mr. Chairman, to hearing your views on these and other important issues. And again, I welcome the news that you will be with us for 4 more years. And again, we have trust and confidence in you, and I know that trust and confidence will not be misplaced.
Thank you very much.
Mr. Neal.
Mr. Chairman, I don't have an opening statement, but I do want to congratulate you for the longstanding interest you've had in the policies of the Fed. Clearly one of the most complicated federal agencies, and one that the public, I think, by and large, has very little comprehension of. But the fact that you've continued to schedule hearings of this sort and to keep interest high among committee members, I think is a testimony to the role you've served here as chairman of this subcommittee. But I intend during the question and answer period to revisit the issue again, Mr. Greenspan, and I've already congratulated you last week about reappointment. But I intend to revisit the issue of the New England economy vigorously with you when you're able to conclude your testimony. I have to say once again that I have not witnessed any relief across New England, and I intend to question you rather vigorously about that at the conclusion of your remarks.
Thank you, sir. Mr. Leach.
Mr. Chairman, I'm not a member of this subcommittee, but I did want to come by just for 30 seconds to indicate, because I think it's
welcome. Thank you for going by.
Appropriate to your subcommittee. And in thinking about it, I just wanted to say that the reappointment of Mr. Greenspan truly symbolizes the vindication of integrity in this very profound sense, that Mr. Greenspan was reappointed even though some of his policies did not meet the approval of the administration during his tenure. And I think that's a very significant circumstance, that despite an independent and vigorous Fed, who has policies we all disagree with, Mr. Greenspan was reappointed. And so I want to congratulate Mr. Greenspan simply on being reappointed on the vigor of integrity, not on the kowtowing of policy. Thank you.
Thank you very much, Mr. Leach.
Mr. Chairman, again, welcome, and we'd like to hear from you, if we can, at this time.
Well, thank you very much, Mr. Chairman. I have a rather extended, prepared statement, and even though my oral remarks will be somewhat extended, I should trust they will be significantly shorter than my written statement, and request, however, that the full statement be included in the record.
Yes, sir. Without objection, that'll be done at this point in the record.
Mr. Chairman, members of the committee, I'm pleased to be here today, as always, to present the mid-year monetary policy report to the Congress. My prepared remarks this morning will take their cue from that report by focusing on current economic and financial conditions, as well as on the outlook for the economy and monetary policy over the coming year and a half. These topics merit particularly close attention at the current time, when the economy appears to be poised at a cyclical turning point, moving from recession to expansion. In addition, I plan to devote some time to discussing the importance of the changes that we have been seeing in patterns of credit usage and in the flows of money and credit through the financial system. There are signs of what could be significant departures from the trends prevalent in the 1980s, with potential implications for the interpretation of financial data and economic developments. At the time of our last report in February, the economy had been declining for several months. Today, however, there are compelling signs that the recession is behind us. Although the turning point has not yet been given a precise date, a variety of cyclical indicators bottomed out by early spring, and some have moved noticeably higher in recent months. Such data strongly suggest that the economy is moving into the expansion phase of the cycle. Nevertheless, convincing evidence of a dynamic expansion is still rather limited, and we must remain alert to the chance that the recovery could be muted or could even falter. In recent months, there also have been promising signs of a slowing in inflation. A bunching of price increases and excise tax hikes at the beginning of the year boosted so-called core inflation measures for a time. But in their wake, an underlying softening trend has become evident, with consumer prices outside of the food and energy sectors rising quite modestly. In an environment of slack demand, businesses have worked especially hard to control costs by keeping their operations as lean and productive as possible. With the threat of an oil-related inflation surge largely behind us and output evidently declining, the Federal Reserve took a series of easing steps in quick succession over the latter part of last year and into the spring. These actions, aimed at ensuring a satisfactory upturn in the economy, brought the federal funds rate more than 2 percentage points below its pre-recession level and 4 percentage points below its peak of about 2 years ago. Other short-term interest rates dropped more or less commensurately. Despite the progressive easing of monetary policy, the foreign exchange value of the dollar is up substantially since the beginning of the year, in part owing to the brightening outlook in the United States for economic recovery without added inflation. Anticipations of economic expansion also were reflected in rising stock prices and in long-term interest rates, which have changed relatively little on balance so far this year, even as short-term rates have declined. With the cumulative drop in short-term interest rates making monetary assets more attractive to the public, M2 growth picked up noticeably in the first half of 1991. Its growth probably was restrained to a degree, however, by the firmness in returns on capital market instruments. Money growth also continued to be held down by the ongoing restructuring of credit flows away from depository institutions. As the thrift industry has contracted and banks have remained quite cautious about expanding their balance sheets, there has been less need for depositories to issue liabilities, which constitute the vast bulk of the monetary aggregates. Currently, M2 and M3 are somewhat below the midpoints of their respective target ranges. In the last several months, monetary policy has adopted a posture of watchful waiting as economic indicators have pointed increasingly toward recovery. With an eye to the usual lags in policy effects, this stance has been viewed as prudent to guard against the risk of adding excessive monetary stimulus to an economy that might already be solidly into recovery. Monetary policy during the first half of the year has had two jobs. First, to help bring the economy out of recession, and second, to avoid setting the stage for the next recession, which would follow if we allowed inflationary imbalances to develop in the economy. The progress against inflation that has been set in motion must not be lost. Moreover, by consolidating and building upon the gains against inflation, we come that much closer to our longer-term goal of price stability. Inflation and uncertainty about inflation keep interest rates higher than they need be, distort savings and investment, and impede the ability of our economy to operate at its peak efficiency and to generate higher standards of living. It is this strategy that has been guiding monetary policy recently, and the effects of the strategy are reflected in the economic projections of the Federal Open Market Committee members and other Reserve Bank presidents. On the whole, their outlook is for underlying inflation to continue to slacken as the economy first recovers and then expands at a moderate rate through the end of next year. Their forecasts for real GNP growth over the 4 quarters of 1991 center on a 1% or a shade below, implying over the remainder of this year that not only offsets the first quarter decline in GNP, but also lifts output above its pre-recession peak by year end. Two fundamental questions must be posed with regard to this outlook for the rest of the year. The first is the inquiry into the potential sources of strength in the recovery, those forces that will be at work to pull the economy out of a recession in a lasting fashion. We see a number of factors as having set the stage for the recovery. In particular, the reversal of the spike in world oil prices and the favorable effects on that reversal on real incomes, the conclusion of the Gulf War and the consequent rebound in consumer and business confidence, and finally the decline in short-term interest rates following our policy easings and the narrowing of risk premiums in financial markets. Against this backdrop, consumer expenditure growth seems to have turned positive again, along with real income. Home building has bottomed out and is providing some lift to overall growth, and orders for capital goods are pointing to a firming in demand that should be reflected in production and shipments in coming months. The strongest force behind output growth in the near term, however, probably will be the behavior of inventories. Business inventories have been drawn down aggressively in recent quarters, and with inventories now quite lean, sales increasingly will have to be satisfied out of new production. The inherent dynamics of an inventory cycle, as the drawdown ceases and eventually turns to rebuilding, likely will engender the bulk of the initial step up in output. But there may be additional areas of demand that will impel the recovery. It is quite common at this point in the cycle for forecasts both to underestimate the strength of the recovery and to miss the forces that end up driving the expansion. In fact, recessions typically have been followed by periods of appreciably stronger growth than that foreseen here. This raises the second question about the near-term forecasts, that is, whether they are optimistic enough. A number of considerations come to mind on that side of the issue. First is the simple notion, which has lent some support by history, that relatively mild recessions beget relatively mild recoveries. And this recession, assuming it came to an end in the spring, seems to have been mild. Not only does it appear to have been marked by a considerably smaller contraction in real GNP and industrial production than the average post-war recession, it also was a bit shorter. Arguing against a rapid rebound in the economy are several other factors as well, including the lack of impetus from some sectors that contributed in earlier cycles. First, it has not been unusual to see some fiscal stimulus in the early stages of expansion in the past. This time, however, the Congress and the administration have worked long and hard to make sure that genuine progress will be made in righting the structural imbalance in the budget, putting federal spending in real terms on a downward path. Nor is fiscal stimulus likely to emerge from the state and local sector, where deepening budget problems are constraining spending. A portion of the financial distress of localities can be traced to the softness in real estate markets, feeding through to property tax receipts. The condition of the real estate market also is certain to restrain the pickup in construction that usually accompanies a recovery, with overbuilding in commercial real estate likely to damp activity in this area for some time to come. Finally, in the consumer area, expenditures are unlikely to grow more rapidly than personal income, as households avoid reducing their saving rate further from its already low level. The expansion is seen as becoming more securely established next year, with real GNP growth strong enough to bring the unemployment rate down a half a percentage point or more from its current level. Should the recovery unfold about as we expect, price pressures will remain muted and progress on inflation is likely. The expectations of the FOMC members and other Reserve Bank presidents for inflation this year are centered in the neighborhood of 3.5%, well down from the 6.25% rate of inflation experienced last year. Although the slowdown this year is exaggerated by the retreat in oil prices, a clear deceleration should be evident, even abstracting from energy prices. That deceleration in the underlying trend is expected to continue next year as well. However, the unwinding of the oil shock this year masks the improvement, so that the projection for the increase in overall consumer prices is about the same for 1992 as for 1991. The FOMC viewed the near-term outlook for output and prices as generally favorable and consistent with growth of money and debt within the ranges that had been specified earlier in the year. Consequently, at its meeting earlier this month, the FOMC reaffirmed the 1991 ranges for money and debt growth. In addition, it was felt that money ranges retained enough scope for policy to be responsive should the economy stray substantially from its expected path over the remainder of the year. Unlike the monetary aggregates, our latest reading on debt of the domestic non-financial sectors places it right at the bottom edge of its 1991 range. Its growth has been unusually low, and its position within the range is indicative both of the reduced demands for credit associated with the weak economy and of the restraint on the part of borrowers and lenders that has been evident in recent quarters. In these circumstances, the FOMC felt that lowering the monitoring range would be inappropriate and might falsely suggest a complacency on the part of policymakers about weakness in credit growth. Instead, maintaining the debt range unchanged underlies the implication that a further slowdown in this aggregate would warrant close scrutiny. On a provisional basis, the FOMC extended the 1991 ranges for money and debt growth to 1992, with the understanding that there will be opportunities to reevaluate the appropriateness of these ranges before they come fully into play next year. The ranges were viewed as consistent with additional progress against inflation and with sustained economic expansion. Moreover, the path of no change appeared most sensible to the committee at the current time of some uncertainty about the vigor and even the durability of the economic recovery, as well as about developments affecting the future of thrift and banking industries. This uncertainty about the credit intermediation process is one of the factors that could possibly make movements in M2 somewhat difficult to interpret in the short run. But I would emphasize that we expect the aggregate to remain a stable guide for policy over the longer run. The relationship between M2 and nominal income has been one of the most enduring in our financial system. Presumably, this reflects an underlying demand for liquidity on the part of businesses and consumers that is associated with a given level of spending and wealth. This demand is likely to persist, though the financial structures that supply the liquidity may change. Recently, patterns of financial intermediation have been changing, and there are signs that patterns of credit usage in general have been changing as well. It is difficult to know which of these developments will show some permanence and which will prove ephemeral. But some of the recent changes have been striking and have affected a number of the financial variables that the Federal Reserve routinely monitors in an effort to glean information about the health of the economy, the soundness of the financial system, and the appropriateness of current monetary policy. I would like to address several aspects of these recent developments in the remainder of my remarks today, Mr. Chairman. First, at the most aggregate level, the ratio of domestic non-financial sector debt to nominal GNP, which soared in the 1980s, is beginning to show signs of flattening out. With the federal government's borrowing lifted by the effects of the recession and payments related to deposit insurance, these signs have been evident so far only in other sectors. While the changes in behavior may in part reflect cyclical factors at work, a longer-term trend also may be emerging. And this trend, if it fully develops, would represent a return to the pattern evident in earlier post-war decades. The deregulation, technological advances, and financial innovations that came at an accelerated pace in the 1980s lowered the cost of borrowing for many and probably raised the equilibrium ratio of debt to net worth for a wide range of economic entities. A temporary surge in borrowing was implied in the course of this transition from one equilibrium to another. A tapering off of that surge would then be expected as the new equilibrium was approached, and this may be what we are currently witnessing. If these sorts of adjustments were in train, the slow debt growth associated with them should not be read as implying that credit was insufficient to support satisfactory economic performance. On the supply side of the credit market, perhaps the major factor at work in creating a break with the behavior of the 1980s has been the adverse consequences of that behavior. It is clear that a significant fraction of the credit extended during those years should not have been extended. Now financial institutions, regulators, and taxpayers are facing the wrenching unwinding of those lending decisions. A key lesson to be learned is how important it is to avoid these costly adjustments in the future, and that this can only be done by avoiding a return to such financial laxity. A more prudent approach to capitalization and lending decisions is overwhelmingly a healthy development that ultimately will result in strengthening balance sheets for the nation's financial institutions and more assurance of stability of the financial system. In certain areas, however, the credit retrenchment appears to have gone beyond the point of sensible balance. In some cases, lender attitudes and actions have been characterized by excessive caution. As a result, there doubtless are creditworthy borrowers that are unable to access credit on reasonable terms. Even in the obviously troubled real estate area, new loans are arguably too scarce, in some cases intensifying the illiquidity of the market for existing properties. To an extent, the scarcity of some types of loans may reflect the efforts of individual financial institutions to reduce the share of their assets in a particular category, such as commercial mortgages. While a single bank may be able to do this without too much trouble, when the entire industry is trying to make the same balance sheet adjustment, it simply cannot be done without massive untoward effects. Instead, it may be in the bank's self-interest to make the adjustment in an orderly manner over time. Regulatory efforts to address credit availability concerns continue. Not only the behavior of the debt aggregate itself, but also the avenues through which the debt flows represent something of a break with the past. The recent decline in the importance of depository institutions as intermediaries, when measured by the credit they book, is quite striking. While this predominantly reflects the contraction of the thrift industry, banks too have contributed by growing only slowly. Over time, other financial institutions have provided more close substitutes for banking services, and the profitability of the banking industry suffered over the last decade or so from a decline in loan quality. As banks make further strides in bolstering their capital positions, however, they will become better able to take advantage of opportunities to add profitable loans to their balance sheets. While the role of the banking industry has been changing, its importance in the financial system and the economy remains assured. In sum, Mr. Chairman, the financial system in this country is changing, and it is changing rapidly. Technology, regulatory initiatives, and market innovations are changing many dimensions of the financial system. The relationships between borrowers and lenders, between risk and balance sheet exposure, and between credit and money are being altered in profound ways. In response, we must understand the nature of these changes, their permanence, their limitations, and their possible implications for the economy and monetary policy. And we must assure that the stability of the financial system is protected as changes occur. For a sound financial system is an essential ingredient of an effective monetary policy and a vital economy. Thank you very much.
Thank you, sir, Chairman Greenspan. First, before we get into the main thrust of your testimony, just a little housekeeping matter, if I may. Last week, on Tuesday, July 9th, the Wall Street Journal ran a story which said that after considerable discussion, your open market committee agreed to leave the key growth target for the monetary measure known as M2 at 2.5% to 6.5% for next year, the same as this year's target range. It's a long story, and it goes into some great detail about your meeting, the results of which you report to the Congress and the world at these semi-annual hearings. Now, as I read this story in light of your today's testimony, the story is essentially accurate, suggesting to me that somehow there's a leak within the Fed there that is troubling. It's troubling because if it is not important that this data be made public at the times called for by law, then it should be made public the day you do it. And if it is important, it suggests a certain problem with competence that somehow information is getting out that shouldn't. So could you talk about this a little and tell us what happened? And
I read that article, Mr. Chairman, and I must tell you I was most distressed. I, however, think I know how that information got out, and unless I am mistaken, that opening, if I may put it that way, is now currently closed. Whether or not I am correct in my evaluation, only time will tell, but I can certainly agree with the thrust of your remarks that that is something which we should be chagrined at seeing occur.
Are you saying that you've corrected it so we won't see it reoccur?
I think I understand how that information was obtained, and I trust I have taken steps which will avoid that in the future.
Thank you. While we're on the subject, how about commenting a little bit on this question? Others from time to time have suggested that there's no reason for waiting even a minute in terms of letting your decisions be known. I personally think that the more sunshine we have in government activity, the better. The more that we can do in the open and full public view, the less suspicion there is of our institutions, the more accountable they are to the public, the better the policy that's likely to develop. Is there some good reason for not making public the conclusions of your deliberations, coincidental with arriving at them? Is there some reason for delay?
Yeah, first of all, Mr. Chairman, let me say that I certainly agree with you in your view that for public institutions, short of the issue of the efficiency of the operations which we are required to implement, full public disclosure should be forthcoming in all respects. The only reason that one can argue for the failure to do so is that it impedes the purposes which the Congress has authorized us to engage in. The reason why we are quite cautious in the form in which we release market-sensitive information is how the information is released and when affects markets and affects the actual implementation of policy itself. As I think I've mentioned to this committee on previous occasions, we view our specific monetary actions in terms of either those in which we wish to be very visible and in a sense make an announcement effect, and those in which we believe that a smooth continuum of policy without disruptions to the market actually contribute best to the overall policy thrust of the Federal Reserve. To the extent that we would be required to make all actions immediately available, which in a sense is an announcement, we lose part of what I consider an important element in the structure of policy capabilities. And even though we recognize that in many instances the issue is marginal, there are enough occasions, especially when markets are particularly disrupted by events outside the aspect of monetary policy, or even outside, caused by external events even outside the country. It is important for us, in my judgment, to be able to have as many tools as we can in an endeavor to stabilize the system. Finally, let me say, Mr. Chairman, that it is very difficult for us to release the minutes of our meetings very quickly in order that they be compiled and edited and checked. So there'd always be a delay in that respect. And I'm not certain that we'd ever be able to be in a position, even were we desirous of doing so, of communicating completely all of the actions in a real-time sense. In summary, I would just say to you, Mr. Chairman, I think that while I very much appreciate and fully subscribe to the notion of the necessity of a public institution such as ourselves being completely open, there are times when, in so doing, runs into conflict with what the Congress itself encourage us to do in the most efficient manner.
I understand this. I'm wondering if it wouldn't be useful for you all to do a little brief on this subject, using some examples from recent history, maybe maybe the aftermath of the '87 crash, or some other time when you think it has been useful to have available to you something other than what you call the announcement effect.
I'll be glad to do so.
Thank you, sir. I believe that would help us in keeping available to you a tool that I agree is useful to you. My time has expired. Mr. Roth.
Thank you. Thank you, Mr. Chairman. Chairman Greenspan, I'm going to follow up on the Chairman's line of questioning. The Fed is shrouded in secrecy, and within the Fed's open market committee disagreement about the policy, that's been a long tradition, I guess, but it seems recently there has been an unusual amount of bickering. Is there dissension among the committee members as how we should deal with inflation?
Well, Mr. Roth, I don't agree with the premise that there is an unusual amount of bickering. On the contrary, the thing which has impressed me more than most anything else about my first term as Fed chairman is the collegiality of the operation. I do think that there may be more open discussion than usual, but I would argue strenuously that bickering is most inappropriate term to describe what is going on, and I would say that the overall philosophy of the FOMC and the currently non-member presidents is remarkably, I would say.
Well, it could be, Mr. Chairman, that we just have people with stronger opinions on the board now than we've had before, more free-thinking people, and of course that would be healthy, wouldn't it?
Well, I'm not even sure that that is the case, because my impression of the past is that the board has always been peopled by fairly significantly forward-thinking and strong personality type members. I think that's good, not bad, and frankly, the extent to which these discussions induce people to change their minds is a suggestion that substantive things are being discussed.
Mr. Chairman, I wasn't going to go down this line of questioning, but I just want to tell you what people in the cloakroom are saying, and then you can respond, or I'm going to ask you in a letter to respond to some of these things. And in the cloakroom, I hear a lot of congressmen saying, you know, they are concerned about what the Fed is doing, and they do have, you know, confidence in you. But they say what we should have is a comptroller general look at the Federal Advisory Council, the Federal Open Market Committee, and all the Federal Reserve banks and their branches, and so that there is a lot of openness, so we don't have the shroud of secrecy. Do you think such a thing would be a good idea? Is that a good concept, or?
No, Mr. Ross, as I've indicated to you previously, I think it is not a good concept, will not achieve what it is endeavoring to do, and what I'd like to do is to spell out for you in detail in a written response precisely why.
Okay, I appreciate that, and we were told yesterday that deficit is going to be increasing by some $60 billion, by some $60 billion. This, of course, is something that I'm very much concerned about, and I know others are. Well, what's your advice to the Congress on the deficit?
Well, first of all, the budget agreement, which was hammered together last October, was an agreement which I suspect very few people liked in total. Nonetheless, I might add I would certainly subscribe to that view myself. But nonetheless, the basic structure that was put in place is clearly one which will lead to a very significant reduction in the deficit through time. It is the apparent first successful structure of procedures which will enable spending to be restrained in a manner which is consistent with the long-term necessity of a balanced fiscal system.
Mr. Greenspan, this is very important, however, because we were told that our deficit is going to be $280 billion. Now it's a $60 billion increase. That would be $340 billion. There's no way we can live with a $340 billion deficit. And yes, you're right. There was a hard, hammered-out agreement last fall. But golly, that's not going to get us to a balanced budget, is it?
Well, remember that a very substantial part of the deficit, which is projected for next year, of necessity, by its nature, is temporary. That is, a goodly part is deposit insurance costs, the thrift bailout, and specifically, there are some accelerations of defense expenditures caused by the need to replenish some of the inventory reductions during the Gulf War. But most importantly, there has been a major change in the presumed relationship between the levels of income that are related to the gross national product and the presumed tax receipts that are coming off that income. I'm not sure whether or not that revision is right or wrong, but it is something which we will be looking at to make sure that those estimates make sense. But even under the extreme conditions of the most pessimistic relationships, there is a very dramatic decline in the deficit through time. But no question, I certainly agree with you, were we to have to live with $350 billion deficits, the economy would be in very serious shape. But I don't anticipate that, and I believe that we will be seeing marked progress on the deficit through time.
My time has expired. I thank you, Mr. Chairman, for answering my questions.
Thank you.
Mr. Neal.
Thank you very much, Mr. Chairman. Mr. Greenspan, I don't profess to know more about monetary policy than you do, and certainly it's not my intention to trespass into your realm of competence. But I do know this. In New England, there are more vacant storefronts, longer unemployment lines, and more responsible businessmen and businesswomen who cannot get routine credit. But would you concede this morning that the Fed was slow in coming to acknowledge the problems of the New England economy?
No, I don't think so, Mr. Neal, largely because I think we were acutely aware of the extent of the problems emerging there. So my recollection is that concern about the nature of the New England economy rose quite early in the game at the Federal Reserve.
For months, including forums similar to this, I questioned you about the credit crunch. The initial reaction from you and from the Fed was that there was not a credit crunch in New England.
I think that is correct, and I think I want to distinguish between the early stages of the moving from what was very evident lending laxity to more normal lending patterns, which appeared to have the characteristics of a credit crunch, was indeed something which was healthy, not something which was deleterious. And it is only as we began to perceive that the initial move from laxity to balance began to continue in an adverse direction towards excessive caution and indeed actions which we perceive to be unnecessary, that we began to define what was occurring as a crunch. There's never been a problem in understanding what the processes were. I mean, we were fully cognizant of the pulling back in lending standards, of pulling back on the general evaluation processes that banks and supervisors tend to make, but that was something which was essential and, in my judgment, healthy to the economy. And as a consequence of that, I would not define that this economy, or for that matter, any aspect of it, began to move into a meaningful credit crunch until we had moved over the line. And that, in my judgment, was well into the process.
I think that the term you used in your testimony was that we've moved beyond a sensible balance.
That's correct.
Okay. Well, the truth of the matter is it hasn't gotten any better months after we acknowledged the problem. We've heard a number of times witnesses before the full banking committee and this panel indicate that they were going to address the issue in New England, and there isn't any plausible evidence at this time that that process has begun.
Well, I wouldn't want to agree with that, Mr. Neal. I think that we have been spending a good deal of time on the issue of the credit crunch, have been fully aware of what is going on in New England, and the president of the Federal Reserve Bank of Boston, Richard Siren, whom I know you know, has been in fairly consistent contact with those of us at the Federal Reserve Board in Washington, both at the board and at the staff level. And we have been, in conjunction with the other regulators, endeavoring to find means to bring the credit crunch to a halt and to turn it around. I grant you that it has not turned around, but I do think there is increasing evidence that it is no longer getting worse, and that is at least the first step. If you ask me, would I prefer that it were much better? I certainly would. Do we intend to pursue this issue until we can say that it is better? The answer is yes.
The point that I would simply like to make, and I'd like to move on to another question, is that you more or less declared this morning that there are a number of indicators that would suggest that the recession is behind us. I just want to tell you firmly and emphatically this morning that is not the case in New England. Or I certainly haven't witnessed those indicators that I think that the layman might come to acknowledge or recognize as supporting the evidence that you've offered this morning in your testimony.
No, I think it is definitely the case that New England is dragging behind the rest of the economy, and the evidence is there of a turn of far more muted than they are in other areas of the country.
Let me speak to the issue of the national savings rate, which I think you've eloquently addressed. And incidentally, I have great confidence in your decision-making, except in this particular instance. Let me speak to the issue of the national savings rate. There are a number of proposals floating around Capitol Hill, one of which I've sponsored, that would support the idea of returning the IRA. And if we're not going to move in the direction of returning the IRA or some sensible vehicle for upping the national savings rate, what do you suggest to us this morning? I mean, we've run around this issue a number of times now, and yet we don't seem to be any closer to taking the kind of vigorous action here on Capitol Hill that would in fact offer some incentive to encourage people to save.
I testified before the Ways and Means Committee a number of weeks ago, Mr. Neal, and I must say with similar testimony before Senate Finance. And the general thrust of the way I came out confronted with the same dilemma that you're raising was that even though the evidence on the IRA is not by any means conclusive in that it will improve the national savings rate, the issue of national savings is so crucial to this economy that we probably ought to take risks in that direction and endeavor to try to move towards a form of renewed, expanded IRA, fully aware that we may end up with very little in the way of net savings, but on the other hand, it might be a definite plus. So I think it's worthwhile at least taking a shot at it.
Thank you. Mr. Chairman, could I ask for 30 more seconds? Thank you, Mr. Chairman. So you're willing to state again today for the record that the #1 economic problem that faces America is the low national savings rate?
Yes, most definitely. The long-term problem.
Thank you, Mr. Chairman.
I'd like to welcome, there are several members of the full banking committee here this morning who are not members of the subcommittee, but we always welcome other members of the committee to our subcommittee hearings. We think it's valuable to hear their thoughts and points of view, and it's a way of getting those out to the public. Mr. Leach, I'd like to call on you at this time.
I defer to any member of the subcommittee first. No, Mr. Dunn. No. I just had one issue I wanted to raise with you, Mr. Chairman, and that is obviously the news of the day relates to a major bank merger in New York. And from a congressional perspective, it seems impressive that a consolidation has occurred without the infusion of public monies. Can you reveal to us the role of the Fed or the attitude of the Fed, or both, in relationship to this merger?
Well, Mr. Leach, as you, I know, are aware, the Federal Reserve Board will be required to review and express either approval or denial of this merger. And I think under those conditions, I'm restrained at this stage from preliminarily discussing views which I will have to be part of which will be part of an adjudication process at some later time.
Thank you, Mr. Chairman.
Mr. Kennedy.
Yeah. First of all, Mr. Chairman, I'm glad to see you're here this morning and looking healthy. I just wish the economy was looking as healthy as you are, at least in my region of the country. But I want to congratulate you on your reappointment, and also just hope that you are feeling as well as you look.
Thank you very much, Mr. Kennedy.
I'm worried, as as Richie Neal was speaking with you, about the New England region and the general state of the economy. It seems to me that we're hearing talk this morning about the fact that there's been some success in keeping the inflation rate under control, which I think that, that there's no question you've been able to do a reasonable job on. On the other hand, we've got unemployment rates that are going into double digits in New England. And it's not just in New England. There are other parts of the country that are stumbling along at best. It just seems that if you look at what Mr. Roth was talking about, you've got a deficit that was announced in the paper this morning of being $348 billion. You've got a situation where the credit in New England has been stifled. It's very difficult for small businesses, medium-sized businesses to gain access to the credit markets. You've got a general feeling, I think, on everybody in the United States that at least I come in contact with maybe the exception of Wall Street, which I never quite understand why, when everybody else thinks it's going down, these guys, you know, send the Dow over 3,000 points. It just doesn't seem to make sense. Maybe you could explain that to me as well. But what I'm really driving at is the fact that I think people get a sense in the pit of their gut that somehow the United States is not really making the kinds of innovations, not really being able to get itself prepared to deal with the 21st century in a way that makes us truly competitive with our counterparts abroad. That the savings rates of the Japanese are down, the investments by the Germans in terms of taking an aggressive stand and going into the Soviet Union, addressing the concerns of Eastern Europe and the like, indicate kind of a vibrancy that has been lost by the U.S. economy. And that we sort of, you know, consider all these minute little measurements that you have to come up with in your day-to-day work, and I don't mean to diminish the importance of them, but in terms of whether or not the United States is going to be able to seriously get out and compete with the rest of the world in the 21st century, I've got some real concerns. I just wondered if you might address generally where you see the United States economy going and how we're going to get out of this sort of creeping along 1% growth, or and maybe it goes up 1% this year and it goes back down 0.5% next year, but other than an overstimulation that we perhaps saw in the 1980s, how do we begin to get this country moving again?
Yeah, well, I think you're raising the crucial question about long-term economic policy, which actually interrelates to the issue of national savings, which your colleague from New England raised earlier. The total labor force, which is currently in place, is determined by, I should say, the labor force which will be in place, say, 10 years from now, is pretty much determined at this stage in the sense that the number of people who will be in that labor force are already born or already becoming educated, and we can forecast with some degree of accuracy where the labor force will be. That essentially leaves the growth in the GNP or the economy overall to output per worker. And that fundamentally, as best we can judge, relates to the level of investment, or more specifically, investment per worker, which in turn gets to the question of an adequate level of savings to engender that type of investment. The savings rate is unquestionably too low, and we're going to need to raise it. But it's important for us to focus very clearly on the issue of productivity, technology, education, all of the elements which get involved specifically with how to improve output per worker. Because we're not going to change in any measurable form how many people are in the labor force, how many people are working over the years ahead. And we've got to get an upswing in productivity, which I must say has improved some in the 1980s. But we've got to enhance it even faster if we're going to get the type of growth that you're suggesting, Mr. Kennedy.
So then, is there, doesn't that in fact raise two questions? First, that in the short term, I'd rather hear you talk about the long term, but in the short term, that if you take the money that would normally be invested in some sort of durable good, or you know, just that the measurements that you use to determine whether or not the economy is being stimulated and is working, in fact, lowers the savings rates. Because, I mean, it takes money out of people's pockets to make, to go out and buy the washing machine. And if what you really want is the banks to have the money, and so that they can make the loans to the innovative entrepreneur who can go out and come up with a breakthrough in technology. Aren't those two really at opposite ends of the equation?
It appears that way in the short run, but if you think in terms of the way the economy evolves, what tends to happen is both savings and investment rise proportionately, or equally in effect, depending on how one defines it. And that, in turn, raises the level of aggregative economic activity so that consumption, whether it's for durable goods or others, rises as well. So one is not confronted with the issue of trading off one good versus another. What we're trying to achieve is a much larger overall level of economic activity which would enable increased production for all types of goods.
Okay, my time is up, but I just wanted to conclude, Mr. Chairman, briefly by maybe asking the Chairman if it would be possible to get, even in writing, or if you ever have a few minutes, to get some ideas about what you can actually do to stimulate the savings rate in this country, particularly as it seems that we're going to be spending so much of our dollars just paying off the deficit anyway, even the interest on the debt. So I think that there's been a sort of a dearth of ideas. I mean, we've got these gimmicks of the IRAs and things like that, but as to whether or not you actually get people to put money into the long-term investments that are necessary to get these increases in productivity, I just haven't really seen. And I think that you can ask the American people to make those investments, but I don't see any political leadership, I certainly don't see the President or anybody else talking in those terms to the American people about what the real challenge, the fundamental economic challenge to the country are. You hear a lot of platitudes about no new taxes and this and that and the other thing, but what you don't hear is what the people of the country are supposed to actually do in order to achieve the goals that you're talking about. Anyway, thank you, Mr. Chairman, for having us here this morning.
Thank you. Well, I think you're onto the key, the point myself. If for a prosperous future, we need a greater level of savings. It's the single, I think, most important issue for our economy. Is that true, would you say?
I think it's the toughest public policy problem we have in the economic area.
Now, there is something that the Fed can do, and I think is trying to do, that will help. And that is, just sort of looking at human nature, if you think that the value of savings is going to be maintained, I think it's human nature to save. I mean, I remember years ago, if you forgive me, this little sidelight here, being amazed, I was in China back in the late 70s. It was before the so-called normalization, and the Chinese were very proud of the fact that they maintained the value of their currency. It was one of the very keys they saw to the success of their economy, such as it was. I mean, it was not a very successful economy, I'll have to say, but there was one thing that they did, and that is that the Chinese, as little as they made almost nothing in terms of a living wage, and yet they felt confident in saving their money because they knew that the government would not allow the money to lose its value. And so actually, the working people in China making we couldn't possibly live on what they were making, would put some of it aside. They would save it for their old age because they would not allow inflation in that country. And I just, again, back to my pet project, there is just, the one thing that the Fed can do, on the fiscal side, the thing that we could do that would be the most help would be to reduce the deficit. That's the major dis-savings in the economy. It's the Fed can take, I believe. Is that true, would you say?
I've said that many times, Mr. Chairman, so I could say nothing more than I agree.
Much more than any gimmick. I mean, we talk about the gimmicks, Mr. Kennedy's right. They don't, like you're right, there's no real evidence that IRAs and so on really increase the overall level of savings. You want to they want to take a shot with them, fine. I mean, I'm not against it. I think I'm a co-sponsor of a bill that would do that. It might help a little bit. But does it really get to the core problem? No, it doesn't. If you want to get to the core problem, then we have to really go at the basics, balance the federal budget or get closer to it, and on the monetary side, reduce and keep inflation low. Mr. Duncan.
Thank you, Mr. Chairman, and you've touched a little bit on what I want to ask about. Mr. Greenspan, Mr. Kennedy mentioned that there's a report today that says the administration has had to revise upward its estimate of the deficit for next year to $348 billion, and some people think it may even go higher than that. And to some of us who really don't understand these things, we aren't economists, losses of $1 billion a day at the federal level and a national debt of well over $4 trillion are scary things, and they cause great concern, to put it lightly. Does all of this federal debt and do all of these huge deficits, do they cause you great concern, and what effect are they having on our economic posture in this country today, and can we have any sustained long-term recovery unless we get the federal government under control from a fiscal standpoint?
I am very concerned about the level of the deficit, and I have been for quite a while. I have argued before the Congress on innumerable occasions the importance of getting the drain on private savings down, which is, of course, what the federal deficit does. It drains away some of the private savings which would otherwise go into productive investment. I was quite chagrined at the state of affairs that was emerging with our inability to come to grips with this in years past. But even though, as I've indicated earlier, that I, like everyone else, had troubles with the particular elements with the budget agreement that took place last October, I suspect that we may finally be seeing a mechanism which will put this huge, burgeoning problem under control. I did not like, nor did I feel comfortable with the revisions that I saw, as you saw, yesterday. However, knowing how the process is functioning, I have still confidence that we will see a significant reduction in that process, and very specifically on the size of the borrowings which the federal government has taken on, which, needless to say, has created fairly significant pressure in the financial markets. I don't think there's any question that at least some of the problems that we're having with long-term interest rates higher than we would like is that the supply coming on the markets is continuously very large. But I'm hopeful that we will soon see that change, and certainly if the Congress adheres to the various procedures that are implicit in that budget agreement and acted into law, I'm hopeful that we will see a significant reversal in this process.
So you think we're seeing some light at the end of the tunnel, so to speak, then on that? You think we're seeing some light at the end of the tunnel then on that?
I should hope so.
All right, let me go in another direction. You say in your testimony that the credit retrenchment appears to have gone beyond the point of sensible balance. And we've heard other testimony in this committee about how more and more lending is being done by non-bank lenders who are not subject to all the rules, regulations, and red tape that the banks are put under. And you say that regulatory efforts to address this credit crunch and these credit concerns continue. How do we walk that thin line, or what do we do to walk the line between the public's demand for tight regulations on the banks to get the crooks, so to speak, and yet allow some flexibility or leeway for the bankers? We had a banker from Ohio who testified one day in front of the Financial Institutions Subcommittee, and he said, you know, every loan, even the best loan, has some risk to it. And he said the bank regulators won't let us take into consideration things like future earnings prospects and character and goodwill and things that we used to be able to take into consideration. They want to know only about cash flow. How do we tighten up on one hand and loosen up on the other?
I think, Congressman, you're raising the basic dilemma of bank regulation. I think the best way to do it is to recognize that there is a tendency, both on the part of the attitudes of the lending officers of the commercial banks and the examiners which come into those banks, to be unnecessarily lax in periods when the economy is surging forward, when appraisals for various different types of properties are going straight up, where loans that are being made look inordinately safe, and you get an attitude during that period which turns very dramatically when the economy changes and we get what we're seeing today, namely, in many respects, almost the mirror image in reverse of the attitudes on all the participants of what was occurring at the top of the cycle. I don't know whether we're going to be able to succeed, but I should certainly hope that the direction in which a number of regulators are beginning to try to find ways in which we can take that cycle and smooth it down so that we are neither overly lax in periods of expansion nor unduly constrictive during periods of decline. My impression is, were we able to do that, we would find that this continuous dilemma of whether you're being too tight or too lenient will disappear. But I think you have stated the dilemma, I think, relatively clearly, and that's to a large extent the way we look at it as well.
All right, my time's up. Thank you.
Mr. Hoagland.
Well, thank you, Mr. Chairman, for allowing us non-members of the subcommittee to participate in this hearing. Chairman Greenspan, our banking committee here in the House completed its work last June, and as you know, we reported out a comprehensive bill changing federal banking statutes and regulations. And immediately the bill has run into some intramural differences here in the House, which will no doubt continue. I wanted to ask you, in light of your report, when the bill must pass in terms of granting the borrowing authority to the BIF that the bill contains.
Well, I think that issue has been examined in some detail by Chairman Seidman, Treasury Secretary Brady, and others with respect to when BIF really needed replenishment. And I think it has been the conclusion that there's ample time at this stage to bring the bill, the broad bill, which this committee overall concluded, to the floor in time to get those provisions passed and to get proper BIF recapitalization. I think it would be really most unfortunate if this process was stretched out in a manner which required the House to break apart the BIF recapitalization from the rest of the bill and deal with them separately, because I do think that it's an integrated process, and I think a very sensible bill overall, which this committee voted out, and I should certainly hope that it will make significant headway rather quickly on the floor.
Is it your opinion that it needs to pass this session of Congress? In other words, needs to pass the House in 1991 and should not be held over until January?
Well, Mr. Hoagland, I'm certainly of the opinion that it should not be held over. I think that reform is long overdue, and I would say the sooner the better. And so I should certainly hope that the House of Representatives would see fit to complete this legislation as quickly as feasible.
Let me ask you about two specific policy decisions made in the bill that, as I understand it, are coming under assault over in the Energy and Commerce Committee, and ask your opinion of those. The first is the commercial ownership of banks, and the second are the provisions as written in our bill that amends Glass-Steagall. And I wonder if you might indicate to us whether you support or oppose the position that this committee took on those two issues.
Well, as I testified before this committee in full session, the Federal Reserve supports the principle of joining commerce and banking, although we thought that owing to the complexity of the problems associated with it, that it probably should be an issue that is delayed. With respect to repeal of Glass-Steagall, we are fully in support of its repeal and subscribe to all aspects of the detail of the administration's recommendations, which, as I understand it, were embodied in the committee print and in the committee vote that will eventually send this bill to the floor.
Are there any, understanding that the bill is very complex, other than the commercial ownership issue which you have just addressed, do you have any reservations about any other aspects of the legislation?
Mr. Hoagland, one area that we at the Federal Reserve feel somewhat uncomfortable with is the extent of the firewalls that are implicit in the bill, which is part of the increase in powers. In our judgment, the firewall recommendations in the administration's bill are sounder than those which are in the committee print, in that having reviewed this issue in some detail, looking at the pros and cons, while we subscribed several years ago to a higher level, or I should say a thicker level of firewalls than we would today, we have subsequently reviewed what evidence we have with respect to that and have concluded that we could very well get along, and perhaps beneficially get along, with somewhat thinner walls than we at the Fed subscribed to several years ago, and those walls which are currently implicit in the bill today.
And you're talking in the securities area in
Yes,
particular?
very specifically in the securities area.
Thank you, Mr. Chairman. Thank you, Chairman Neal.
Yeah, thank you, sir. Thanks, Mr. Hoagland. Mr. Chairman, you said in your testimony that you thought the recession was, that we pretty well bottomed out and heading out of this, maybe slowly. Some commentators are predicting what I think has been called by some a double dip, suggesting that we might be coming out of the recession, but then that might be followed later this year or early next year sometime with another little dip. Do you see any evidence, anything to suggest to you that that might be the case?
Mr. Chairman, we have great difficulty in forecasting one turn at a time. To try to forecast two in advance, I think, is straining the capabilities of forecasting techniques. I must say to you, I don't see the elements of a double dip. I recognize the possibility, but then there are all sorts of possibilities that could emerge. But with the various elements that are evolving at the moment, it might well turn out that way, and we might see evidence at a later time that that is occurring. But I must say to you, at this particular point, I find no credible evidence which suggests that's the most likely outcome.
During your testimony, you placed a considerable emphasis on M2. What range for M2 will be needed to achieve and maintain zero inflation? And when do you think that we could expect to see such an M2 growth rate?
Well, first of all, going back to our earlier discussions on this question, on what we really mean by a non-inflationary environment, it's an environment in which what price changes do occur do not have any significant effect on business decisions, or in your terms, in savings or investment, or in any of the other areas of concern. It's apparent from looking at the details of our actually published price indexes that we do not fully capture the improvement in quality that goes on year by year. And a truly zero price change probably is consistent with some modest positive inflation rate as measured by the Consumer's Price Index. I suspect, incidentally, parenthetically, that one of the reasons why we were misled about the state of economic well-being behind the Iron Curtain at the height of the Cold War is we did not fully understand that there is no quality change that occurs in most of the goods that were produced in a centrally planned economy. And that when we were measuring real GNP in the West, we were measuring it in terms of applying price increases which probably overestimated the degree of real price increase and as a result had lower relative GNP. That was apparently not occurring behind the Iron Curtain. In other words, the Trabi, the car that the East Germans produced, was probably the same car in the 1950s as it was before they shut the lines down. And the price may or may not have changed, but the quality certainly didn't change significantly. Even though we endeavor to try to adjust for price in our cars, and that's part of the BLS's procedure in estimating the price index in the CPI, we don't really fully do that. And the cars that we have today are significantly better than they were 20, 30 years ago, even after making these various different adjustments and trying to capture the change in quality. We don't fully capture it, which is another way of saying that when we look at a non-inflationary, or in your terms, a zero economy, I think it's probably closer to 1 to 1.5%, or a 0.5 to 1.5% inflation rate, which is consistent with that non-inflationary goal. So that if you then apply to that inflation rate your expectation of real economic growth, that over the long run specifies where the central tendency for M2 should be to be a non-inflationary, non-inflationary economy. I would think that would suggest that somewhere down the line we probably would want to take another notch down in our targets. But I don't think that we need to have a firm view of doing that at any specific period of time. I'm more inclined myself to watch the inflation rate, the measured inflation rate, come down in line with the monetary patterns that are already in place before we seek to make what you would term, I guess, the ultimate adjustment, which brings us to a non-inflationary environment. I don't think we're very far from that, and I think that we have the capability and I think the necessity of viewing the sustainability of economic growth concurrently with achieving that ultimate goal. I think at this stage we are well on the path of actually achieving the type of goals which we've set out to achieve: a solid economic recovery with the unemployment rate moving down to its lowest sustainable long-term rate, with growth at or close to its maximum long-term sustainable pace, with inflation wholly under control. I think I wish to merely subscribe to the point that you made in your opening remarks, that the experience of Germany and Japan in recent years is suggestive that low inflation does really contribute to growth, and I think it should be a lesson that we must focus upon.
Yes, I think that is a misunderstanding that has been costly to the economy, that somehow low inflation or price stability, zero inflation, is inconsistent with growth, and that's simply wrong. It's the way to maximize sustainable growth.
I certainly agree with that, Mr. Chairman.
I appreciate your comments. And I take that as certainly good news that we're in range of we're close to seeing that accomplishment. And by the way, just for whatever it's worth, I want to say I couldn't agree with you more about the definition. When I say zero inflation, I'm talking about exactly the same thing you are when you use the term, which I'm sure is more precise, the economic profession's term of price stability. It's just that it seems to me that zero inflation is more readily understood and is found more acceptable. But they mean the same thing.
Well, the reason I raise the issue is that it becomes a relevant issue when you're beginning to talk specific numbers about target ranges because of what it is we're endeavoring to measure. In other words, you want to be certain that the true measure that we're dealing with reflects the real world.
Yeah. Well, you know, I guess it's a fairly technical point, though, isn't it? If prices are stable, they're not rising.
Yes.
The idea of rising prices and stable prices are incompatible.
Well, what I'm saying is that if the inflation rate, the actual measured inflation rate is growing at a very small number, for all practical purposes, it's probably a reflection of the fact that were we able to truly capture the quality changes,
there would be zero.
It would be zero.
I understand,
exactly.
and I agree. And I see the point. I take the point. I must say, I don't fully understand how you expect to achieve that, though, with M2 growth somewhere in the ranges that you're talking about now. I think we're 2.5 to 3.5 to 6, something like that. What are the ranges that we have now in this report?
Well, we're now 2.5 to 6.5. 2.5
to 6.5. It seemed to me that an M2 growth rate of 6.5% would be totally incompatible with price stability.
Over the long run, that is correct.
So
that is
there's
not-
going to have to be some adjustment downward in M2 growth.
No, as I indicated in my earlier remarks, at some point, I don't think it is important necessarily to say when, because I'm not sure it's important exactly when that is, that there's probably a final downward notch, a small one, to create target ranges which are consistent with what you may say is price stability.
Well, my time has expired. I want to return to this in just a minute if I can, but I have to abide by the rules here. Mr. Roth.
Thank you. Mr. Chairman, I read all these things about Chairman Greenspan. He's the second most influential man in the country and all these things. I'm curious. 25 years from now, when the young people in the colleges open their textbooks, or when the Wall Street Journal looks back on the Greenspan legacy, what's the legacy going to be? Or what do you want it to be?
Well, I should certainly hope that it will say that we succeeded in achieving the types of goals which I've spelled out many times before this committee, which is essentially to achieve maximum long-term economic growth in the context of a non-inflationary environment, which we perceive as a necessary condition to achieving that long-term economic growth.
And of course, that long-term economic growth, as you had mentioned here, is primarily, or one of the main reasons that we have long-term growth, a strong economy, is going to be the savings rate, right?
I'm sorry,
The savings rate, one of the key provisions, pillars of that is going to be the savings rate.
Yes, I'm not saying that obviously monetary policy can achieve all of those elements, but what we can do is to put in place a policy in which whatever monetary policy can do to achieve that, we have done. But you're clearly quite correct. There are other elements in economic policy, certainly budget policy, regulatory policy, amongst other things, which will be factors clearly related to whether we can achieve what maximum growth is possible in this country.
Well, in this question of legacy, I'm not asking this question lightly, because it tells you what a man is focused on. If you ask him what is your goal, you can see pretty well where he's going to be coming from. And you have listed a number of items, of course, that you are working toward. Now, if you had to prioritize them in this Greenspan legacy, what is the most important? Is it going to be keep inflation under 4%? Is it going to be keep lower interest rates? What is the top priority?
Mr. Roth, I don't view it as priorities, because I think there is essentially a single standard out there which is a balance of policy in which we achieve all of these simultaneously. If we fail to do that, I would say we've come up short.
Okay, thank you very much.
Mr. Neal.
Thank you very much, Mr. Chairman. Mr. Greenspan, are you in favor of a gradual recovery? I mean, you did declare the recession to be over.
Well, I'm not in position to declare anything in that respect.
Well, Mr. Ross said you were the second most powerful person in America, so we would subscribe to your,
Well, I'm
your
glad
thought process on that.
he may perceive that, but I sure don't.
Well, at least you came very close to declaring it over this morning. Do you favor, or does the Fed favor, a gradual recovery? There's ample publicity that's been generated suggesting that because of the condition of American banks today.
Yeah, I don't think we look at it that way. I think that we would like to see the recovery fairly robust. Obviously, the more the better, in the context of not running off the tracks. And I think there's ample room for a fairly significant recovery without that happening.
Okay. Follow-up question to that is, and you touched upon it in your testimony this morning, how do you relate the problems of local governments and state governments across the country to the overall economic problems that we have, I guess, as it relates to consumer confidence as well?
Well, I think that it's a relatively severe problem.
We keep saying things that make people dash to the door I suspect it comes from you as the second most powerful man in the government, and not from my line of questioning.
You leave me speechless. I think the state and local problem is a very severe one. I mean, it doesn't require much to take a look at the individual accounts of the various states and a number of the municipalities to know there's some real difficulties and hardships there. I do think, however, that as the economy starts to turn up, receipts will move, since obviously there is a very close relationship between the receipts, non-property receipts, in a number of these state and local units.
You mean the growth taxes?
Yeah, in other words, taxes. See, if we take the property taxes aside, which are another problem, there's a very substantial part of the tax receipts of state and local governments which are highly sensitive to the economy, and I think that that's going to make a major change. Nonetheless, I do think that there probably is going to have to be, and indeed there is, some fairly significant belt-tightening that's in the process of occurring, and as we see it, there is a substantial, as economists like to call it, a fiscal drag on the economy that's occurring from this issue of state and local governments pulling in. Since a substantial amount of the revenues which accrue to state and local governments come from property, and since property values are obviously been in some difficulty, goodly part of the recovery in state and local governments is going to rest upon the stabilization and recovery of the real estate industry.
Thank you. Mr. Chairman, I found this very helpful this morning. Very helpful.
Thank you. I'm glad you're here. Thanks for coming. Mr. Duncan.
Thank you, Mr. Chairman. Mr. Greenspan, one last question. The President is presently at a summit meeting designed, at least in part, or as one of its goals, it is intended to encourage Russia and perhaps other countries to put more free enterprise into their systems and have less government control of the economy. And yet, I recall reading last summer where the chairman emeritus or the head of Sony made some comments about our own economy that angered some Americans, but one of his main points was he said that the major problem with the American economy today was that American business was over-regulated or subject to too much regulation. We have talked in recent years about deregulation of certain industries, and yet to most of the lawyers in those industries, they laugh about that because they know that the airlines and certain other industries that supposedly have been deregulated are subject to more laws, rules, and regulations today than probably ever before. Do you feel, sir, that our economy is overregulated, and do you think that our economy would grow stronger if we could work some more free enterprise into our own system, or is that not a problem in your mind?
No, I do think that in the very broadest sense, that there's more regulation in our system than is desirable or necessary. Obviously, in certain specific areas, specifically, regrettably, where I'm actually a regulator, it's become clear that certain increases in regulation, such as the various initiatives on international banking that we brought to this committee a short while ago, where these initiatives are required. But having said that, I certainly was fully supportive and continue to be supportive of the general thrust towards increasing deregulation, because I think it's very obvious that it is helpful to economic growth and long-term gains in standards of living.
All right, thank you.
Thank you, sir. Mr. Chairman, back to this question that we were discussing a moment ago. Won't part of our success on achieving price stability, zero inflation, be dependent on the credibility of that effort? That people believing that, in fact, we are serious, that we're going to achieve it and we're going to maintain it. It seems to me that a lack of credibility is the explanation for the wide spread between short and long rates, that it's just not believed. I'm not sure of that, but since we have not maintained zero inflation as a matter of policy, a matter of practice over many years, I think it's going to take some effort to convince investors, the public, that we are serious. So maybe I'm wrong about that, but I'd love for you to comment on that. And if that is the case, wouldn't it be useful to ratchet down these target ranges in a visible sense? And I'm just wondering about the benefit of mystery here. What benefit do we enjoy from not being clear about this? And I guess the only thing I can think of that might explain some reluctance would be changes in velocity, that if there were changes from time to time, that might then run up the growth, and then that might reduce credibility. But anyway, would you comment on this?
Well, first of all, I think that credibility is a very difficult thing to measure. I mean, clearly there's no hard analytical technique that we have which says this is increasing or decreasing. We really don't know. I mean, we can make judgments, we can make guesses, we can get market opinions. However, I think that while I don't dismiss the importance of credibility, far more important is not what you say, but what you do. And
well, then in that light, comment on the target ranges.
No, I basically will. Were we not in a position at this stage where, one, we are dealing with a still fragile, though significantly less fragile financial structure than we had 6 months, 9 months ago, or if we were beyond the credit crunch and the financial structure was back in balance in all respects, I think one could make a stronger argument for moving targets down at this particular stage. Were we in a position where inflation was rampant and we had very high targets and we had to move them down pretty quickly because you can't create a gradualist view of getting inflation out of your system when you're dealing with double-digit inflation and instability? If you say you're going to take it out of the system in 10 years, it means you're not going to take it out of the system ever.
Right.
But we are now at a point where we are close enough, where we have the luxury, if I may put it that way, to decide how we make these adjustments. And I think that we do and should take into consideration the fact that we are still in a fragile system, and that we believe that the actual measured rate of inflation will continue to come down in the context of the targets we are discussing this morning. They will not come down, as best we can judge, to, as you put it, zero or the zero equivalent. And I don't think that we need to do that right away, but I do think ultimately it would be certainly helpful for all of the reasons which you suggest. But I see no need at this point. There's no urgency to initiate that, and I should think that so long as we maintain an overall policy which remains consistent with economic growth in the context of declining inflation, we can adjust sometime in the future as we see fit to get, as you would put it, the ultimate target range from which one would assume a non-inflationary policy would continue to come forth.
Well, ultimately, isn't that going to be in the range of 4%, something like that? I mean, if we assume growth to be 2.5%, if 0 is in fact 1 or 1.5, something like that, it seems to me that that suggests that 4% M2 growth is about what it's going to take to maintain.
Well, I don't want to give you a specific number, but that, obviously it's somewhat not terribly far from that. If you do, say, 1% plus 3% growth or something of that nature, that's not very far from where we are at the particular time. And remember, Mr. Chairman, as I said in the prepared remarks, we continuously review these targets every 6 months. And the purpose of it basically is to make judgments as to whether or not they should or should not be changed.
Well, anyway, I commend you for it. I think you're on the right track, and and I think that because I think that the only way we can accomplish our other economic objectives of lower interest rates, maximum growth, maximum employment, maximum productivity, maximum savings, maximum competitiveness, and so on, is in fact to achieve zero inflation. So I certainly commend you for your efforts, and I think we are on the right path. And it's hard, frankly, to argue about the timing of it. We're probably making all the progress we can given everything else that's going on in the economy. It would be disturbing if we were moving in any other direction, frankly. I just have one other question, and I'll yield one more time. Earlier, well, last year, the Fed and the Treasury were intervening heavily in foreign exchange markets, buying foreign currencies to try to manipulate the value of the dollar. As a result of that, your holdings in foreign currency increased substantially. Now the dollar going up again in value on foreign exchange markets, and that would suggest that the Fed and Treasury have suffered losses in their currency holdings as a result of that. If that's true, I assume it must be true, doesn't that suggest that the earlier intervention was a mistake?
First of all, I think you have to look at the other side of the issue as far as the books are concerned. The early stages of that intervention led to very substantial potential gains, which have now been offset to a large extent, but not fully, by losses. But net on balance in the last 2 or 3 years, although this has not been our purpose, my recollection is it's still net plus rather than a minus, so that there's not been a loss here as I recall the data. Nonetheless, I don't think we should be viewing this type of intervention as endeavoring to make profits for the monetary authorities. It's done for purposes of stabilizing the currency, which has broader macroeconomic advantages. I mean, clearly, a stable dollar will reduce risk premiums and make economic performance, both here and abroad to the extent that others do it, superior to then what it would otherwise be. So what we are trying to do is to create an economic value which the order of magnitude, which is very difficult to measure. And while it may be that in the process there are some foreign exchange losses, it may well be, probably is, very small relative to the economic advantages for the nation that accrue. But having said that, my recollection of the accounts, and this will be defined in considerably more detail in a report that we make in early September, is that net on balance, we've come out okay with respect to the gains and losses on exchange trading.
Well, I know that you're not in the business of speculating on foreign exchange, but it's hard for me to see also the gains from that intervention. Certainly.
Well, I think you're raising the question that obviously we discuss at great length ourselves within the Fed, at the Treasury, and specifically in the various fora which central bankers tend to meet. And the general conclusion, basically, that seems to be fairly prevalent is that intervention cannot significantly alter the major trends in currencies, but it has some capability of success in keeping instabilities down, disruptions at a minimum, and creating a more balanced market which has advantages for trade and capital movements.
Thank you, Mr. Roth.
Thank you. I'm going to just have one short question, and but before I do that, I was going to say I was hoping, Mr. Greenspan, that you would tell the Congress that we've got to do something about these deficits more than just last fall's agreement. I don't like to disagree with you, but I must disagree. I don't think that last fall's budget agreement are going to bring these deficits under control, and I think we've got to do much more. But having said that, there's a very historic meeting taking place in London, as you know, today. I don't think we realize how historic this meeting is until we read history books 25, 50 years from now. And that's Gorbachev coming to the Western leaders in London today. What should the President do when Gorbachev asks for aid? Should we give U.S. aid? What should the Western world do? Should they give aid to Gorbachev? What's your analysis?
Well, Mr. Roth, I think as many of the members of the G7 have indicated in recent weeks, that the most important thing that the Soviet Union could do is to set in place a structure of reforms, specifically in the area of setting up a free market infrastructure, a body of laws, a culture which essentially would enable the centrally planned economy to wither away and a market economy to emerge. I think that, as best I can judge, listening to the remarks of Mr. Gorbachev, that he understands that. And I think what he is essentially endeavoring to do is to communicate to the G7 that he understands that, and I think the conversations hopefully will be a general recognition that the solution to the Soviets' economic difficulties is to move as quickly as is feasible to a market structure and away from what has been an extraordinarily deleterious economic, centrally planned system.
But that's not really answering my question. What should the President do? Should he give him aid? Should the West give him aid?
Mr. Roth, I have communicated my views to the President on that issue, and I should like to leave it there, if I may.
Well, I sure see that's, again, we go back to all the shroud of secrecy around the Fed.
No,
I sure would like to know what you told the President.
That's got to do with the shroud of secrecy, of which I think is most appropriate in which when one communicates views to the president, I think that it is, desirable. It's a long tradition in this country, which I think I subscribe to, that if the president wishes to stipulate what he heard, that's his judgment, but I don't like writing open letters to the President of the United States.
Okay, thank you, Mr. Chairman.
Mr. Duncan.
I have no other questions.
Thank you. On that score, the President, I read a quote somewhere about his willingness to help the Soviets develop a fully convertible currency. What would that mean?
What would it mean?
Yes, sir. How would we...
well, I think you have to define convertibility with respect to the ruble in two senses. First, they have to achieve what economists call internal convertibility, meaning that in a sense the currency has value as legal tender for the purchase of goods and services within that economy, even were it closed. And it's fairly apparent that with the extraordinary queues that still characterize the Soviet system, they do not yet have what we would term full internal convertibility. Once that is achieved, then the question is obtaining convertibility relevant to currencies outside of the Soviet Union, and I think that's basically what he is referring to. The analogy, I suspect, that is involved here refers to what was done for Poland when they devalued and went to convertibility, and there was a large fund that was contributed to by a number of countries in hard currencies to support the Polish currency against the Western currencies, which has to a substantial extent succeeded. But in order to make that succeed in the Soviet Union, in my judgment, there will have to be a major reduction, hopefully, in fact, probably necessarily, an elimination of their huge budget deficit, which currently gets funded mainly, if not wholly, by the printing of money. And unless and until they can shut off the spigot which is creating excess money, which obviously means that the ruble is declining in the black market and in fact in the official markets, until that is done and the monetary overhang, that is the excess amount of currency which is creating these queues in the Soviet Union, until that is done, it will be very difficult to get a stabilized currency for the ruble in the international markets, so that they have got very important major macroeconomic adjustments to make, not to mention the extraordinary huge number of microeconomic adjustments to move from the centrally planned rigid structure which they have to a market system.
So somehow supporting their currency, which is inflated internally, would just amount to a big subsidy through another door.
Well, I don't think anybody would recommend that international convertibility for currency is feasible in the context of very large currency creation of the type that is currently going on.
They're a
in the
long
Soviet
way
Union.
from any kind of international convertibility.
I would think that's I would think
Why
that's
was it necessary to support, you mentioned the Polish situation, why was it necessary to support that? Why couldn't a value be established in a free market?
Well, because they were concerned, and I think rightfully, that unless they stabilize their currency, that is the Poles, that they would be visited by massive inflation potential if the currency began to weaken dramatically. because import prices would then rise substantially, which would work its way through the price structure in Poland and unquestionably disrupt the endeavors that they are currently involved with.
But wouldn't that just signal that they had priced it improperly to begin with? Or were
Well,
continuing
the
to
answer
price
is
it
yes,
improperly?
it would, but the point being is that there is a vicious circle which could begin to emerge, that if your currency begins to collapse, it creates a significant amount of internal inflation, which in turn weakens the currency still
There's
further.
a momentum created there that I see. Okay,
So that the advantage of a stabilization procedure with external assistance is to try to break the vicious circle.
So that's only
prevent
necessary
it from
during
occurring.
a transition period. That's only necessary during a relatively brief transition period.
Yes, ultimately you would want an individual, you would want a country to have adequate reserves to maintain its position after a while. And you would certainly want a situation in which you could stabilize the currency so that the markets would basically then perceive that it would continue to stay stable, and you would soon begin to get individuals willing to invest in longer-term claims against that currency. That is the reason we have 30-year bonds, for example, in this country and elsewhere, is that the holders believe that even though there may be some inflation over the next 30 years, that the major part of the value of that currency will be maintained, and people are willing to make long-term investments. So that what you're substantially endeavoring to do is to create a sense of security about the value of the currency over the longer term, which tends to create a virtuous cycle, if I may put it that way.
I don't mean to, this is not the subject of our hearing. I'm just curious, though. It does seem to me that it did a real benefit to the Soviets, that our central bank, you and your folks, could be a big help to the Soviets in terms of setting up a system to establish some credibility in their currency and a healthy economy. Do they call on you for that?
Oh, yes, we've spoken to them
well, that's great.
on many occasions over the last 2 or 3 years.
Are there other questions, Toby?
I don't have any other question. I was just wondering, however, when you mentioned to the President, gave him your views on what was going to be happening today, did he wink at you, or did he nod, or did he smile? What kind of body language did he have?
You put me in an impossible position, Mr. Roth. I don't frankly remember. But if I did, I would be, if I believe what I said before, which I do, I would not want to communicate. Look, the one thing you will say about the President of the United States is he's very knowledgeable about these issues. And I must tell you that a lot of the times you think you're giving him new information, and he's heard it 10 times before, and he often knows a good deal more about certain issues than you do. So I don't want to suggest that the way the President gets his ideas is that somebody sits there, tells him, and he absorbs it. That's not my impression. I think it's somebody who's been around the horn many times.
Thank you, sir. Well, Mr. Chairman, thank you again for being with us today.
Thank you, Mr.
Very
President.
useful hearing. Thank you.